In this video, we'll take a look at and analyze the top 5 large tech stocks, Microsoft, Amazon, Apple, Facebook, and Alphabet or Google, and also perform a stock valuation on each of them so you can get a sense of what their current fair value ranges might be. To do that, we'll use my custom ValueSeeker stock valuation model behind me to help us in that valuation process. Before we begin, take a second to subscribe if you'd like to see more content like this in the future. For those who have not seen this model before, I'll briefly walk through how it works. If you're already familiar with the model, you can use the timestamps in the description to help navigate to the sections most relevant to you. The ValueSeeker model is a discounted earnings model, so it effectively projects the future earnings for a company and then calculates what's the fair value price you need to pay today in order to achieve a specified rate of return. So in the case of Facebook, we're just looking at a base case scenario, and in this case, we'll be looking at a modeling period over 5 years, and we'll make some assumptions on Facebook's earnings growth over the next 5 years. In this case, we assume earnings will increase 10% the next year, then starting in year 2, they'll increase 13% for each of the next 4 years. The model then uses that information to calculate an annualized earnings growth rate. We input our current earnings per share figure here, and as you can see behind me, that earnings per share growth has been projected out over the next 5 years. If the stock pays a dividend, you'd input the annual dividend here, and if there's any expected changes to the payout ratio over time, you'd also input that as well. In this case, Facebook does not pay a dividend, so we're setting this just at 0. For this model, we're targeting a 12% rate of return, and this can be different based on your return expectations or what rate of return you're targeting. So in your models, you can change this to whatever you like, but just keep in mind that having a higher required rate of return means you'll need to buy at a lower price, and vice versa. And finally, the last input is the expected price to earnings ratio at the end of the modeling period. In this case, we're modeling Facebook will end at a 26 price to earnings ratio. So once we've inputted all of those model inputs, the model will come out with our results for the projection over that time period. The model's calculated fair value is in this cell here, in this case is at roughly $217. The way this is calculated is that assuming all of the model assumptions are true, this is the price you'd need to pay today in order to achieve that 12% annualized rate of return over the entire 5 years. This would result in an expected price of Facebook in 5 years of roughly $382 with no reinvested dividends since Facebook does not currently pay a dividend. The model can then compare this to the current price of the stock to determine if the stock is trading above that fair valuation or trading below, potentially giving you a margin of safety with your investment. Down below here, you can track the expected earnings per share as well as that expected share price and price to earnings multiple changing over time. So this graph is helpful for understanding how much of the return component is coming from different factors, namely earnings growth, valuation change, and dividends reinvested over time. So now that you have a good understanding of the model, let's take a look at the assumption setting process, starting with Facebook. So Facebook, as you know, owns the world's largest social media platforms, the most profitable of which is Facebook, which has almost 1.8 billion users every day. And across their family of products, which includes Facebook, Instagram, Messenger, and WhatsApp, in the second quarter of 2020, almost 2.5 billion people used at least one of their products every day. Facebook makes the majority of their money running ads for their users, so the formula for total revenue of Facebook is pretty straightforward. It's just the average revenue per person times the number of people that are using the site. Generally, as Facebook's been able to increase both the number of active users and the average revenue per user, they've been able to see strong revenue growth over the years. This is quite impressive in this most recent second quarter of 2020, as during the recession, they were actually able to increase revenues by 11%. So going back to our model, there's a variety of resources you can use to help set your assumptions for earnings growth over time. Generally speaking, the more conservative you are in assumption setting, a lower fair value estimate will be produced. Now, over the past 5 years, Facebook has been able to grow earnings well in excess of 13% per year. But in this case, I've set a relatively conservative assumption, assuming they hit 13% growth rate from years 2 through 5. And for the first year, I took off just a bit of that growth rate, assuming that rates are likely slower during the recession, although they have been quite robust so far. The 12% required rate of return, again, is what we're using for this analysis. And I set a terminal price to earnings ratio at 26, which is lower than what it's trading at now, but I do expect that growth will likely slow down at some point in the future, so a lower price to earnings multiple should reflect that. So overall, with this relatively conservative modeling, a price of $217 for Facebook seems to be an attractive value for long-term investors. If you have different assumptions on the long-term growth rate for Facebook, let's say assuming 15% instead of 13%, well, then that fair valuation changes to $232. And if you're willing to pay a higher price and accept a lower expected rate of return, for instance, in this case, let's say 10% per year, then you have a fair valuation price at that 10% rate of return of $254 per share, which in this case is above the current price, meaning it would make sense, assuming these assumptions hold true, to buy the stock. I know there's often a lot of discussion that the FAANG stocks and many growth stocks are quite expensive, but I think it helps actually doing some real model and valuation work and calculate what actually would be a reasonable price based on your assumptions. So the next stock I want to look at is Alphabet, whose main property is Google. Now, in the second quarter of June 2020, for the first time in its history as a public company, Alphabet or Google reported a decrease in revenue. In this case, revenue for the quarter was down roughly 2% compared to the quarter a year ago. Now, part of the reason why Facebook has been more resilient in the recession compared to Google when both are in the online advertising space is that when it comes to the specific ads being run on these sites, Facebook is a lot more focused on direct response advertising. This is designed to get consumers to either click a link or buy a product or download an app or something along the lines of an immediate action. Brand advertising, on the other hand, is more of a long-term investment. As brand advertising is estimated to make up roughly 80% of YouTube ad spend, it makes sense that Google might be more impacted here as advertising budgets are shrunk and more focused on the immediate return of direct response advertising. In addition to this, the largest moneymaker for Alphabet is Google Search, and some of the highest paying search terms are for travel and autos, which have seen significant declines during this recession. So you can take all that information and combine it with both prior growth rates and estimates for future growth rates to determine your own assumptions. In this case, I have an assumed earnings growth rate of 5%, much lower than historically we've seen with Alphabet, and then in years 2 through 5, returning to a 15% growth rate. In this case, I have a price-to-earnings multiple of 25, as typically Google trades at a slight price-to-earnings multiple discount compared to Facebook. From these assumptions, the model assumes an ending price of $2,087, which would produce a 12% rate of return, assuming we could buy the stock at roughly $1,184. Currently, the stock is trading 25% above that fair valuation estimate, meaning that there may be short-term downside risk of up to 20% in the stock if we should see a reversion to this estimated fair value. So when comparing Google and Facebook, of the two at least right now, I think Facebook is arguably the better value. However, I do own both in my own portfolio and plan to continue to hold them for many years. Next, let's take a look at Microsoft. Now, Microsoft has actually seen quite consistent results even throughout the recession, and that is partly attributable to many companies moving up their timeline for their plans of digital transformation, which has accelerated the demand for Microsoft's enterprise software services. Most recently, Microsoft has seen revenue growth of 13%, and that's actually been quite consistent over the last several years and is likely expected to continue going forward. So in this case, I've modeled a consistent 13% growth in earnings over the next 5 years. Now, probably where there's most debate in modeling Microsoft is what is the right terminal price to earnings multiple. Taking a look at the long-term view of Microsoft's stock price above, their earnings in the middle, and the price to earnings ratio below, we can see that that price to earnings ratio has increased from roughly around 10 in the early 2010s, and Microsoft now is trading with a price to earnings ratio over 30. Now, the spikes in price to earnings ratio represent one-time impairments that occurred to earnings, which aren't really representative of the true trend. So ignoring those spikes, you can still see that Microsoft's valuation multiple has increased steadily over the last decade. Now, this valuation expansion cannot continue to infinity, and there's a point where investors will say that it's simply too expensive. However, what's really the right valuation multiple? Well, Microsoft back in the 2010s at a price to earnings ratio of 10 was an incredible value, which didn't properly reflect the growth prospects for the company. I think a price to earnings ratio around 24 fairly represents that, but I can certainly see arguments for a higher price to earnings multiple when you compare Microsoft to the multiples of many other SaaS companies. SaaS companies being companies providing software as a service, typically under a subscription model, and these companies have historically traded at very high price to earnings multiples. So assuming a price to earnings multiple of 24, which is what we'll look at to start with, we get an expected fair valuation price of $154. Now, compared to the current, at least at the time of this recording, price of $216, the model's telling us that the stock is 40% overvalued to that fair value price, or implies a roughly 30% downside from current levels. However, if, let's say, based on your analysis, that a proper price to earnings multiple might be actually closer to 30 for Microsoft, then that downside risk starts to look a lot more reasonable compared to the current price, as the fair valuation has increased now to $192. This does, however, put a little bit more risk in your assumptions, as you have to assume that Microsoft indeed does hit these 13% growth rates, but in addition to that, that investors 5 years from now will be willing to pay 30 times earnings for Microsoft's earnings at that point. So those are just some things to keep in mind. Microsoft, I think, is a fantastic business and company, but the stock is arguably pretty expensive. In order to justify paying the current prices for Microsoft, you have to assume that investors will be willing to pay a relatively high multiple for the stock in 5 years. With the company executing as well as Microsoft, that is certainly possible, but it is something to consider. Next up, let's take a look at Apple, and this is certainly, again, one of the most popular stocks out there. In addition to having some of the most popular products, Apple has generated significant returns for investors over the years. In this most recent quarter during the recession, Apple has been able to generate 11% revenue growth, and earnings per share is up 18% compared to the quarter last year. Now, much of this growth was attributable to strong iPhone sales, but their services segment is still growing quite quickly. Many people believe that the high growth in the service segment is arguably part of the future of Apple as an investment, and is used as justification for why investors should be willing to pay a higher multiple for Apple than they have in the past. Taking a look at the price to earnings multiple over Apple, which is that third bottom graph, you'll notice that Apple is currently trading at the highest price to earnings multiple since the early days of the iPhone growth. There have been many periods over the last decade, specifically in 2011, 2013, 2015, and early 2016, and late 2008, where Apple has traded at multiples in the low teens, i.e. this being a price to earnings multiple somewhere between 10 and 13. Now, however, Apple is trading at price to earnings multiples 2.5 to 3 times those cyclical lows. Are these price levels really justified? And can Apple maintain such a premium stock valuation? Those are going to have to be key questions you ask yourself when you're doing modeling for Apple. In this case, Apple has seen recently quite strong growth in earnings per share, so I've modeled that at 13% for the first 2 years. However, I do think that will have to slow down, which I've reflected as an 11% growth rate over the next 3 years following that. Personally, I think this is actually a relatively aggressive assumption, because we have seen periods in the past where Apple has had no or even negative revenue growth, which is partly attributable to iPhone sales, which make up still a large component of revenue and have historically been somewhat cyclical. Add to that the fact that while Apple has been very shareholder friendly, giving back significant amounts of capital to investors in the form of dividends and particularly share buybacks at a price to earnings multiple above 30 will simply not be as effective in adding value to shareholders as they were in the low teens. And really, again, it comes down to what is the proper multiple to pay for Apple stock. Apple's certainly a fantastic company, so I think it deserves a premium multiple, but is 30 plus really justified? In this case, I've set it at 19, which will give us an example benchmark for what we're looking at in the model. In this case, assuming the model assumptions are true, Apple is relatively significantly overvalued, or at least expensive, compared to our assumptions. In this case, we have a fair valuation of roughly $265 compared to the current price of $235, meaning that if we were to see a reversion back to this fair valuation based on our assumptions, it'd be a downside risk of roughly 39%. Now, another neat thing we can do with this model is that we can actually estimate what the expected future returns would be for Apple investors at the current price, assuming that all our model assumptions hold true. The way we do this is we adjust the required rate of return such that the modeled fair valuation equals the current stock price. In this case, with a little bit of trial and error, we can see that a 1.3 annualized rate of return is what investors would expect to get over the course of 5 years, assuming all of these model assumptions hold true. From the return component graph, we we can see that while earnings have contributed to that expected return, almost just as much of return has been subtracted by that valuation multiple coming down over the course of those 5 years. So if we see Apple trading at a price to earnings ratio of 19 in 5 years, paying $437 per share, this is prior to the 4-to-1 stock split, doesn't seem like a very attractive opportunity when you take into account both the risk and reward. Now you can certainly set your own assumptions which may get you to come to a different conclusion, but at least my view right now is that Apple is quite an expensive stock. And speaking of expensive stocks, no discussion would be fully complete without bringing up Amazon. Now, Amazon has been a significant beneficiary of the environment surrounding the recession. Not only has it seen an explosion of growth within its North American retail segment, with net sales up 43% and operating income up 37%, but international sales have seen significant growth as well, with net sales up 38% year over year, and the segment reporting its first operating profit. In addition to this, AWS remains the dominant player in the cloud space, with sales up 29% and operating income up 58% over the last year. As the push towards accelerated digital transformation continues, this growth is likely to be strong going forward as well. Now, it's because of this such strong and robust growth that investors have been willing so far to pay such a high price for Amazon stock. Now, modeling with high growth rates can be challenging because even a small change in those high growth rate assumptions can make a fairly substantial difference on the ultimate stock fair valuation price. In this case, I've assumed an annualized growth rate of 25% over each of those 5 years. Amazon's currently trading at a price to earnings ratio of well over 100 when it's historically traded at around 80. In this case, I might actually be making quite a conservative assumption, assuming Amazon will be trading at a 50 price to earnings multiple in 5 years, in which case, based on that annualized 25% growth rate, the stock will be nearing $4,000 in that time. Now, if all those model assumptions were true, this would get us to a fair valuation of roughly $2,252, which is about 28% lower than the current price of $3,112. Now, given the very high growth rates and also expected high valuations for Amazon, this is what makes modeling the stock quite difficult. So let's say given these circumstances, Amazon is actually able to grow even faster than we've modeled here in their expectations. For instance, say Amazon achieves a 35% growth in earnings over the next year and then 30% annually after that. Well, then our fair value jumps quite significantly, now just 9% less than the current price. And if we assume that the price to earnings ratio actually ends up at 65, well then the expected price of Amazon in 5 years will be close to $6,500, meaning that if we actually bought Amazon today at its current price, we'd be buying at a 16% margin of safety or discount to its true fair value, again assuming all our model assumptions are true. It's important in modeling and doing your valuation work that you don't model with an end result in mind. Doing so may influence your decisions in setting assumptions to try and end up with a predetermined result. Ideally, you want to set your best estimate assumptions first and end up just seeing what the model results are. If they end up differing from your expectations significantly, well, then that's a new insight you've gained. Based on our model's original assumptions, I don't think I'll be a buyer of Amazon at its current price, though that might change in the future. Now, for across these 5 stocks, we've just looked at the base case valuation, but you can also build an unfavorable and favorable valuation case to get a range of estimates of a fair value to pay for each of these stocks and give you a sense of both the potential upside and downside case scenarios. If you'd like to see my full model valuations and assumptions, those are actually available for download now on my investing platform, which you can check out in the link in the description below if that interests you. Overall, I hope this helped give you a good sense of the valuation process, especially when applied to today's largest technology stocks. If you have any thoughts or questions on what we've discussed, let me know in the comments section below. And I'm curious, out of the 5 big tech stocks, which do you think is the best value today? And if you enjoy this type of video and content, let me know by leaving a thumbs up, and I'll try to make more of it in the future. Until then, thank you so much for watching. My name's Michael, and I will see you in the next video.